Well, thanks everyone for tuning in this week on our Mortgage Matters here with Chris. Chris, you've done a lot of refinances in your 26-year career, so we're very excited to hear from you on kind of the inside perspective on that. You know, Chris, I recently saw a statistic, and I don't remember the exact number, but it was saying that credit card debt is at the highest it has ever been since credit cards came out. And a big reason for that is maybe people are putting more on credit cards as inflation stuff is going up, but the interest rates on credit cards are going up right now because of the inflation and the federal funds rate increases and things like that. So thought this would be a good time to revisit, at the same time that our debt is at an all-time high, people's home equity is also at some pretty impressively high numbers, how much equity people have in their home.
Right.
So, the good disclaimer here is that everything is a case-by-case example, and what worked for one person might not work for another. But I do think there's a lot of people that could benefit from looking at, can their home equity that they are sitting on help them accelerate their financial situation and get out of other types of debts that are rapidly increasing. So, Chris, thank you for being here with us today. So let's dive in, Chris. Can you kind of give us an idea what you're seeing in the refinance world right now from the inside perspective?
Well, I mean, I've been doing quite a bit of refinance loans over the last 6 months. And I'm actually surprised too, because a lot of those clients that we're working with are refinancing. If they're not just doing a straight up equity line, and they're doing the full refinance, to pay off, whether it's debt, they're doing upgrades to the house as well. They're kind of taking advantage of all things. And at the end of the day, they're still spending less than they were on that 3% interest rate. I don't encourage people just to refinance out of these low rates, just to refinance. Again, it's to your point, it's a case-by-case situation. But really the true purpose of the podcast is to provide everybody here listening a clear understanding on how refinance can help reduce some debt and save on interest payments, maybe on other cards. Now, it's not the be-all, end-all. It's not the solution for everybody, but I'm seeing more and more people using this as a solution. You get the mortgage interest write-off on your taxes. The monthly payment, it happens to be a lot less just because of the debt that they have accumulated. So I want you to think of it. It's pretty interesting because I'm going to just kind of give you like to what you want to think of it. Refinancing your mortgage, it's kind of like trading in, if you will, your old car for a more efficient model. All right. Right now you have this, imagine you're driving this gas guzzling car, and it's not just the car, because you got the car, but you got all this other stuff in the car that's costing you money. Like I'm just saying, credit card debt, maybe it's a huge car payment, maybe it's all this other stuff. And it's just costing you a fortune to live or to run this car. It's been a great car. It's reliable. It's 3% rate, right? But, every month that you fill up the tank, it's just draining your wallet. Every single month, you're just paying and paying. And then one day, you notice that there's a new model out there. It's a hybrid, so it's completely different, meaning it's a higher rate, but it's a hybrid, and it boasts a high fuel efficiency. And, you're going to trade your old car in for this new one. And the monthly fuel costs and all the other costs that you were accumulating by driving this other car suddenly drop significantly. And over the long run, what you're going to discover is that you're going to save a lot of money, and even accounting for the cost of this new car, at the end of the day, you're going to save all that money. So refinancing your mortgage is similar, right? You're trading in your current mortgage and getting rid of some of that outstanding debt, whether it's credit cards, could be cars, could be multiple things, right? All of them have their set interest rates, which is way higher, right? And what you're going to do is you're going to make your monthly payment more manageable by freeing up some of those funds so you can live, whether it's inflation, whatever it is. You got a cost of living, and it keeps getting more expensive and more expensive. At some point, maybe it just makes sense to get rid of that, right? And get into this new mortgage with the costs and closing costs. We look at the whole closing costs, how many years you paid in, and we can just show you the true savings at the end of the day. And I do have an example that we will share with you just to kind of break down, just so you can kind of hear it. And if you are a person that has the time, or you're at your desk listening to this, or kitchen table, get a pen and paper, because you can write this stuff down, some of these numbers. And sometimes I am a visual person, so seeing is believing, and it's kind of hard to do it if it's a podcast, right? I can't, it's like cutting your hair over the phone. I can't quite do that, but I can help you, encourage you to take some notes, and then you can have that. Does that make sense?
Yes.
Awesome. So let's, the first thing that we want to always do is we want to understand the basics, right? We want to understand debt, your home equity, and your refinancing, right? So what I want you to do is I want you to think of your home. You got your home. I want you to think of your home as this huge piggy bank, okay? And in this huge piggy bank, the money that you pay towards your mortgage are the coins that you're putting into your piggy bank every single month, right? So every month you're making a mortgage payment. You're putting your coins into your piggy bank. You're right. And over time, as you continue to add more coins and make more mortgage payments, your piggy bank becomes more filled. And in this analogy, not only does it become more filled, we also have a piece of appreciation too. So your house is getting valued more, and the more that you start paying off and down that, you have this big bucket of equity. So now I want you to imagine right now that you're sitting there and you need some extra cash. Pay off credit card bills. Maybe it's a car. Maybe you want to do a kitchen. You want to do a remodel in your house, do the bathroom, whatever it is. And you don't know where you're going to get this money because you have no savings, but you have this piggy bank, right, that we're not thinking about. But so essentially what you're going to do is you can borrow against that equity that you've built up in your home to pay off these other debts. And the more equity you have, the more you can borrow. So, and what that means for you as a consumer, as a person that owns a home, is for those of you who don't own a home, think of, you're paying somebody else's into someone else's piggy bank. You're just dropping money. So that person that owns a house they can refinance their investment property and get some money to eliminate some debts. So think of your house just as that, right? And but I don't want you to think about emptying your whole piggy bank at once, right? So you may consider just tapping into part of it as a home equity line, right? You don't have to do a full refinance on your house. Maybe you have, the average person, they say in this country right now, has 30% equity. So yes, essentially you're going to stretch out your mortgage payments over a longer period of time, which means paying more interest over the life of the loan. So you have to consider that. So there's always, for every positive, there's a negative. But in a case of need, you have $7,000 a month coming into your home, and you have $8,000 a month in bills. You might not have a choice, right? You have to do something, because I only have $7,000 coming in. I make whatever, $80,000 a year, $100,000 a year, but I got $105,000 of debt a year, whatever that looks like. So think of your house that you've been sitting in. If the average person has 30% equity, especially over the last few years where we've seen this rise, you may have an opportunity, to do it as a one-time loan, if that makes the more sense, or an equity line. And that all depends on where your loan to value is and how much equity that you have. So now I want to just move to the third thing that we're going to talk about right now, is the scenario. Let's break down a scenario to kind of give you what that looks like. So those of you who have pen and paper, I'm going to talk about a guy who has a $500,000 mortgage. You might have took it out 3 years ago, 4 years ago, you got 3.25%. All right. And this guy has about $75,000, or this lady has $75,000 of credit card debt, or debt, however you want to look at it. So right now, based on her mortgage payment, and we're just talking rate and term, guys, because taxes and insurance is going to follow the new loan. So I just want them to keep the numbers very simple. This is just a rate and term number. Based on that number, if you have a $500,000 loan, right, for 30 years, amortized for 30 years at 3.25%, that payment's $2,176 a month. Now let's just say you have $75,000 worth of debt, right? At 3%, that's $2,250 in minimum payments that are designed to take you 30 years to pay. So if I add those two numbers, the $2,176 that my mortgage payment is, I'm paying, I love that rate. I got 3.25%, my mortgage $2,100. You do a $500,000 loan today, It's not $2,100, right? You're winning. Everyone's singing and dancing. But you got this debt you accumulated over the last 3 or 4 years. Maybe you did upgrades when you moved into the house. You did all this stuff and you just started building up all this debt. Well, that payment's $2,200. So when I add those two numbers, I have $4,426 right now that I'm obligated to pay between my debt and my mortgage. Very simple. So here's the solution. I'm going to give you the solution on one loan. It's very similar if you do two, because you'll keep the $2,176 and then you'll do a smaller loan for $75,000 or $100,000 on the second mortgage. But let's just assume you do one. Okay, either way you're going to win. You do one loan for $600,000. Okay, at 6.875. Let's just call it that, or it could be 7.5. That's going to change the payment a little bit, not by much. Let's just say 6.875. Right now, that gives you about, after cost of doing the loan, if it doesn't get rolled into it, maybe it gives you another $15,000 of cash in your hand to $25,000, right? So you got cash in hand because maybe you're going to do some improvements, or you got to upgrade your car, you're going to do something. So you got a little cash in hand, eliminate all the debt. You got a straight up loan for $600,000. You had one for $500,000. Well, the new payment on that loan is going to be $3,942. One payment. All right. So you went from paying $44.26 a month down to $39.42. Okay. So that's a substantial difference. Almost $500 a month in savings. Now, it didn't sound like a good deal when you hear that 6.875 interest rate. That sounds scary. You're like, oh my word, my mortgage payment's going to go up. But however, this other debt isn't going to go away, especially if you're making minimum payments. It's not going anywhere. So sometimes you have to do what you have to do. You just have to do something. There's got to be a solution. Fortunately for most people out there, they have this equity that's sitting in their piggy bank that they can draw on to get themselves and climb themselves out of debt. So that $6,000 a year of savings could make a huge difference in lifestyle.
Well, not only that, but, you know, the average family who's paying, 40% more in groceries every week, like $500 a month goes a long way to make up for what we're paying in inflation elsewhere.
Correct. It does. And, you know, what I want to encourage people to think about, too, is let's not just think about jumping to doing refinancing. I'm definitely not doing it, but it's definitely a hot topic with the debt that people have accumulated over the last 3 or 4 years for whatever reason, whether it's inflation reason, whether it's the cost of the cost of goods and all that stuff, and they're just in a position where they have to use their credit card. What I want you to do is you need to consult with a good financial advisor. You got to consult with a mortgage banker. But my job, right, and what my goal is just to educate you on what that looks like and what that looks like. So you might have not even considered it, but you're drowning, right? And you don't know what the solution is. Well, it might be right there, at least right over your head, right? Your roof. You might be like, oh, I never considered doing this, but if those numbers work. So to summarize, right, I just want to go into a couple, just to summarize everything. I'm going to actually probably be 20 minutes today, which is going to be a complete miracle, right? I want you guys to set up the stage. I want you to look at your finances, figure out what you have, talk to somebody, get a good understanding on how much credit card debt you have. Do some investigations. How long would it take me to pay minimum payments on my credit card debt? Don't just take my word for it, right? Look it up. Do some research. Call your preferred banker, mortgage banker. We'd love to be your preferred mortgage banker if you're listening. Again, you could be in a position to take that $500 and maybe you're putting in an investment. Maybe you're plugging that back into something that's going to grow for you right now. There's a lot of different options. That's why I tell you and really tell you, talk to your financial advisor, talk to your mortgage banker, talk to your pastor. I don't know. Talk to whoever it is that you want to talk to, your trusted confidant, but come up with a plan. If you're in one of these situations, it's something good for you to investigate. And if it's not to do the full refi, equity lines are great, right? The equity line, the difference between the equity line and doing the full mortgage is that full mortgage is going to be more on a fixed rate. So that 6.875 is fixed, where equity lines are really tied to some kind of, it could be the fund, so it's to a different kind of funds. It could be the treasury, it could be something else that it's an adjustable rate. And their terms are a little bit different. Sometimes you can draw on an equity line for 10 years and then it's based on a 20-year amortization. So it makes that payment a little higher. It could be interest only for 10 years and then you got to pay all the money. So there's different terms on the equity line, and that could be a whole other conversation for us to do on another podcast, is really to really nail down what a home equity line looks like and the different funds that they're attached to in some cases, and what those adjustments look like in terms. But there's two choices that you can have, whether it's actually three: a fixed second mortgage, a home equity line, or a full refinance to get yourself out of debt. And my phone is always open if you guys have any questions. But I'm going to leave you with one quote, which I think I wrote down. Where is my little notepad here? I'm going to hold it here so you don't see it. But my quote is from Tony Robbins. Knowledge is not power. It's potential power.
That's good.
Execution trumps knowledge any day of the week. So whatever your situation is, hopefully I'm giving you some knowledge. If you're in one of those situations, just remember, execution always trumps knowledge any day of the week. And I hope you guys have a great rest of your week. If you have any questions, call us, follow us, YouTube, Facebook, Twitter.
Podcast platform, whichever your favorite is.
All of them. And I'm always here to answer any questions or help. It doesn't have to go into a mortgage deal either. I'm here to help and offer any kind of advice or any kind of information that I can share with anybody out there that's watching and listening.
Awesome. Well, we're going to be talking about refinance all this month of September. So if you have more questions related to this or any part of refinance, send them to Chris, and then we will address them in one of the later episodes. Chris, thank you so much for imparting your knowledge and giving us some potential power with that. And everyone, we will see you back here next week, same time, same place. And I hope everyone has a wonderful weekend.
All right. Thank you. Good seeing you, Mindy.
Bye-bye.
Bye now.